If you're new here, I'm Paula. On this channel, we zoom out. We look at macro, liquidity, geopolitics, and how it all feeds into markets and crypto. Not from a headline perspective, but from a structural one. Because headlines are noise, structure is what moves capital. And right now, something structural is building in the Middle East. What's happening there isn't just another regional flare-up. It's not just one isolated conflict. It's multiple pressure systems sitting on top of each other in one of the most economically sensitive regions in the world. And what stands out to me isn't just the tension, it's the relative calm in the markets. Because when you step back and look at the geography, the incentives, the energy flows, and the macro backdrop, you realise that this has the potential to reprice things very quickly if certain lines get crossed. So let's zoom out properly. When people say what's going on in the Middle East, they usually mean one conflict. But this isn't one conflict. You have the ongoing war in Gaza, you have the persistent tension across the Israel-Lebanon border, you have Iran backing multiple regional actors through funding, training, and strategic influence. You have the elevated risk across the Red Sea shipping corridor, and right now, beside all of that, is one of the most important energy choke points on the planet, the Strait of Hormuz. Roughly 20% of global oil supply moves through that narrow stretch of water. That's not just a geopolitical statistic, that's a macro vulnerability. Recently, we've seen warnings and heightened signalling around transit through the strait. Now, it's important to stay precise. There has not been a confirmed, sustained physical blockade that shuts down global supply. But shipping doesn't operate purely on formal declarations. It operates on perceived risk. And when risk rises, insurance premiums rise. When insurance premiums rise, flows slow. When flows slow, energy markets start paying attention. Markets care about flow, not headlines. And right now, the flow hasn't broken meaningfully. That's why oil isn't exploding. That's why we're not seeing a full-blown panic across risk assets. Because traders are pricing elevated probability, not confirmed disruption. That distinction matters. Oil markets don't move on emotion. They move on supply imbalance. If supply is physically constrained in a sustained way, oil reprices fast. But if supply continues moving, even cautiously, you get a controlled risk premium instead of a shock. Right now, what we're seeing looks more like a controlled war premium than a supply collapse. And that's why the markets are calm. But calm doesn't mean safe, it means conditional. So let's walk through the transmission mechanism slowly, because this is where macro actually lives. If oil were to spike meaningfully, not 5%, not 10%, but structurally higher and sustained, that feeds directly into inflation. Energy is embedded in transport, it's embedded in manufacturing, it's embedded in agriculture, it's embedded in almost every other consumer supply chain. So higher oil eventually filters into CPI. Now think about the macro backdrop we're already in. Central banks are balancing growth risks with inflation persistence. Markets are positioned around the idea that we're either at peak rates or approaching easing cycles. Liquidity conditions are expected to gradually improve, not tighten. If energy inflation resurfaces aggressively, that timeline shifts. And when timelines shift, bonds move, yields rise. And when yields rise, the dollar often strengthens. And when the dollar strengthens, global liquidity tightens. That's the chain reaction. Geopolitics, energy, inflation, rates, dollar, liquidity, risk assets. This is mechanical. It's not emotional, it's not political, it's structural. And crypto lives inside liquidity cycles. Now here's where nuance is important. Bitcoin sometimes trades like digital gold. Sometimes it trades like high beta tech. Which version you get depends on the macro context. In liquidity expansion phases, crypto thrives. When yields fall, when the dollar weakens, when financial conditions ease, that's where speculative capital expands. If energy shocks reverse that temporarily, crypto doesn't disappear, but volatility increases, risk appetite compresses, altcoins feel pressure faster than Bitcoin, leverage gets flushed. That's not fear, that's mechanics. Whenever geopolitical risk rises in a meaningful way, capital seeks safety. Historically, that means US Treasuries and the dollar. Even when the United States is indirectly involved in global tension, capital still flows towards dollar-denominated liquidity because it remains the deepest pool. So if escalation intensifies, you could see DXY strength. And a stronger dollar is generally not friendly to global risk positioning in the short term. Now let's talk about incentives, because incentives explain why we're not already in a systematic shock. No major global power benefits from an uncontrolled regional war in the Middle East. The United States needs energy stability. Europe is still energy sensitive. China relies heavily on imported oil from the region. Russia may benefit from higher oil prices at the margin, but not from a destabilised global financial system spiralling into crisis. So the current equilibrium is tension with restraint, pressure with signalling, risk with containment. That doesn't eliminate the possibility of escalation. It just explains why escalation hasn't happened yet at a systematic level. Markets are not naive. They are conditional. They're watching the same red lines we should be watching. What are those red lines? A confirmed sustained physical disruption of the Strait of Hormuz. Not warnings, not rhetoric, physical obstruction that meaningfully reduces daily oil flow. Direct and sustained military confrontation between Israel and Iran at a state-to-state level. Or a full-scale northern expansion that pulls multiple state actors into open conflict beyond proxy engagement. Those are the escalation thresholds that would likely force markets to reprice risk quickly. Until then, we remain in a contained tension phase. Contained does not mean stable, it means fragile. And fragility matters because it compresses reaction time. When structural pressure builds quietly, the release can be fast. Now let's talk specifically about crypto positioning. We're in a cycle where liquidity expectations matter more than almost anything else. Spot ETF flows, institutional positioning, rate expectations, dollar trends. These are driving capital allocation decisions. If energy shocks reintroduce inflation pressure, you may see yields move higher temporarily. If yields move higher, duration assets feel it. Tech feels it, speculative flows slow down. Bitcoin may hold relative due to its structural demand, but altcoins are still highly sensitive to liquidity contraction phases. We saw this dynamic during previous geopolitical spikes. Initial volatility, correlation spikes across risk assets, then stabilisation once flows normalise. So the key variable is not whether headlines intensify, it's whether energy flow is meaningfully disrupted long enough to change macro expectations. Because once macro expectation shifts, positioning shifts, and positioning moves markets. Right now, oil has a premium, but not a shock. Yields are elevated, but not breaking structurally higher due to energy. The dollar is strong, but it's not surging because of a supply crisis. That tells you markets are pricing risk, not disaster. And this is why it's so important to stay analytical instead of reactive. If you're trading purely off headlines, you'll constantly chase volatility. If you're watching structural indicators, oil levels, shipping data, maritime insurance costs, US 10-year yields, DXY strength, you'll see repricing before social media does. That's the difference between reacting and positioning. Zooming out even further, this region has always been an energy fulcrum. In the 1970s, oil embargoes reshaped inflation. In more recent decades, tanker disruptions created short-term spikes. But each time, the magnitude of market reaction depended on physical supply impact. not rhetoric. Markets don't price fear, they price constraint. So where are we now? We're in a phase of elevated geopolitical risk, sitting beside a critical energy choke point during a fragile macro cycle where central banks are navigating the edge of easing. That's why this matters, because the macro system is sensitive. And when the systems are sensitive, small disruptions can create outsized reactions. The real question isn't whether conflict continues, it's whether energy flows remains uninterrupted. If it does, markets digest this as risk premium. If it doesn't, macro reprices quickly. And when macro reprices, crypto reprices. Equities reprice, liquidity reprices. Everything is downstream from liquidity. So, what am I watching? Oil levels relative to structural resistance, shipping volumes through Hormuz, insurance rates on maritime transit, US 10-year yield behaviour, dollar index strength. Because those will move before narratives change. Right now, this situation is serious, but not systematic. It's tense, but not broken. And markets are calm because flow is intact. The moment flow breaks, calm disappears. So the question for you is this: do you believe incentives continue to favour containment? Or do you think one of those escalation thresholds eventually gets crossed? Because if it does, the repricing will be fast. And personally, I'd rather be early in understanding structure than late reacting to headlines. If you found this helpful, make sure you're subscribed. This channel is about staying ahead of macro shifts, not chasing them. And if you, as always, want to know the exact strategies we use in the Crypto Wolf Pack to navigate both the bull market and the bear market, we've made a completely free course for you. The link is in the description below. Let me know your thoughts in the comments. Are the markets underpricing this risk, or do you think containment holds? Thank you so much for watching, and I'll see you in the next one.